The yen and Japanese bond yields were jolted sharply higher overnight on talk of an early Bank of Japan rate hike. While elsewhere, the focus is on US non-farm payrolls tonight, and where the markets are being too optimistic about a soft landing in the US. That's coming up in our 5 Things in 5 minutes. And then, in our bonus deep dive interview, ANZ's head of G3 Economics, Brian Martin, explains why the Fed's rate cutting he sees starting in the September quarter of next year is likely to be much smaller than the previous series of rate cuts, and why the markets might be getting ahead of the Fed.
The FOMC are fully aware that the market is getting very optimistic about when rates would be cut, and the Fed has been that more reticent about it. I side with the Fed on this one. I think that they need to be patient.
But first, in 5 and 5 with ANZ, the Japanese yen jumped 2% overnight to 143.9 to the dollar, and the 10-year JGB rose 10 basis points to 0.75%. That's on renewed speculation the Bank of Japan could tighten its main policy rate back to, wait for it, 0% from being minus 0.1%, possibly as early as December the 19th. The 5-year JGB jumped an almighty 10.5 basis points to 0.34%. That's plus 0.34%. Here's Brian Martin on why the longest awaited tightening in the history of monetary policy is being talked about again. It all started with a visit by Bank of Japan Governor Kazuo Ueda to brief Prime Minister Fumio Kishida.
And then Ueda was being questioned in Parliament about monetary policy, and he said it could be a difficult end to the year for monetary policy, and that suddenly fanned expectations that possibly some move in the policy framework is afoot.
Now, one fear is that Japanese savers who hold lots of US treasuries will bring their money home. That dragged US Treasury yields and the US dollar lower against most currencies, including the Aussie and Kiwi dollars. The Aussie is up at 66.15 US cents at 5 o'clock Sydney, Melbourne time. The Kiwi up at 61.91. The S&P 500 and Nasdaq are up around 1% in late trade. Number 2. A theme is developing globally of financial market expectations of rate cuts, getting well ahead of what central banks are both forecasting and saying. ANZ New Zealand's chief economist Sharon Zollner says the same is true for New Zealand, which began hiking before most in October of 2021. It's unlikely to cut before most, says Sharon.
The market is certainly expecting the Reserve Bank to be cutting well before the Reserve Bank itself is anticipating that. And that is, of course, a global theme. I think it's probably fair to say, though, that the gap is unusually large in New Zealand. The Reserve Bank made it clear in November that, as well as watch, worry and wait, they were adding another W, willing to hike again if necessary. And necessary was basically if inflation surprised on the upside at all, that they've run out of patience. Not that inflation actually lifts again, but just that it doesn't fall as quickly as they are forecasting.
Number 3. One reason central banks in Australia and New Zealand are talking hawkishly is they both now have a couple of months off before they can talk or move monetary policy again. It's the summer in this part of the world. The RBA's next decision is not until the 6th of February, 2 months away. The RBNZ is not due to decide again until February the 28th. That's 3 months since its last decision on November the 29th.
Well, they're certainly talking tough, and I think that's with half an eye on this very, very long break before the next meeting, and the fact that they are well aware that the market is keen to price cuts, and that could actually result in the easing of monetary conditions over the summer. So I think that certainly explains the words. But in terms of what they've actually done, New Zealand and to some extent Australia do stand out for not having raised policy rates to anywhere near the highs that they did in the last cycle ending in 2008, for example. So they're certainly talking tough, but they haven't actually brought out the really big stick.
Number 4. Australia's trade surplus improved by almost $1 billion to $7.1 billion in October from September. Iron ore exports rose and imports of machinery fell. But, interestingly, from a consumer economy point of view, imports fell only slightly, and some types of imports by some consumers are still going gangbusters. Here's ANZ Australia economist Maddie Dunk on a jump in car imports. They hit $3.8 billion in October.
The fact that we saw this 13% lift in motor vehicle purchases means that there is a segment of the population who do still have appetite to spend right now.
Number 5. Global markets are now on tenterhooks for the all-important non-farm payrolls data from the US later tonight. The consensus is for jobs growth of about 180,000 in November. Brian says anything over 200,000 could unravel some of the market's confidence about a soft landing.
I think it would suggest if you did get a strong number that the market has got ahead of itself. And yes, you could see quite a sell-off in bonds at the front end of the US Treasury curve, and it could lead to some dollar strength.
Brian Martin there. Now, ahead of those non-farm payrolls and the FOMC's decision next week, here's our bonus deep dive interview, again with ANZ's head of G3 Economics, Brian Martin. He sees the Fed cutting only 200 basis points in this cycle, rather than the average of 500 basis points of cuts seen in previous cycles going back to the mid-1980s. He says this time is different for a few structural reasons.
In this cycle, we're not in a structural decline in inflation, as we were in the post-Volcker era, and which intensified significantly in the aftermath of the GFC. We're seeing a normalisation in some of the drivers of inflation. And these are things like wage growth has picked up, and owing to a structurally tight labour market, we think it's going to remain reasonably tight and levels consistent with reaching target inflation, rather than deflation as we had in the post-GFC period. Fiscal policy is expansionary, and whilst we expect the fiscal multiplier to slow in the year ahead, indeed in the years ahead, the government is still spending a lot. It's got its infrastructure bill, it's got the climate spending in the Inflation Reduction Act, and these things are going to ensure that the potential for a deflationary environment to unfold in the economy isn't there.
So when do you think the Fed could start cutting? And do you think the markets, which are talking about second quarter or so of 2024, might be getting ahead of itself?
We think the conditions for the Fed to start cutting interest rates should be in place from middle of next year onwards. We've penciled in the third quarter for the start of the cutting cycle. And that's because we believe monetary policy is now adequately restrictive, that the level of nominal and real interest rates that the Fed have achieved through this tightening cycle are now bearing down sustainably on inflation. So that's something that the FOMC are going to welcome, and I think that's something that will be acknowledged when the FOMC meets for its final meeting next week and holds the press conference on the 13th of December. However, I'm not as gung-ho as the markets are on when the FOMC will be able to start cutting interest rates. There's still a lot of work to do. Yes, when you look at the annualised rates of inflation, they're improving, and they seem to be improving sustainably. But the Fed will want to see a broad-based improvement in inflation. So it's going to look at various different cross-sections of measures. And services inflation in the economy, measured by the PCE deflator, which is the broad and favoured measure of inflation that the FOMC targets, that's still running at 4.4% year on year. And on my calculations, it's going to be the middle of next year, at the earliest, before that comes down to levels that the FOMC can say, yep, we're happy with the improvement in this, and we think it's going to be sustained, and that it will fall towards target over our forecast horizon.
ANZ's Brian Martin there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, December the 8th. Have a great weekend. Look out on Monday for analysis of tonight's non-farm payrolls in the United States. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.